Now we're going to kick off talking about what's happening in Asia. And we really want to start with China because I think the birth rate, which is the key component that we've been talking about, and again, it's not going to show up right now, but this is a long-term issue that is going to be very pronounced as they continue to see their birth rate decline. When you look at where they are versus historics, you get an idea of just how low it's gotten and how it's been a steady decline. So this isn't something where you could say, oh, well, COVID is the cause of this, so the moment COVID is over, this all ends. That's not the case. And I think that's a really important caveat when you look at the different underlying annual births per 1,000. And then again, when you pivot over to births in China fell below 10 million in 2022, but you can see that it started to decline well before the 2020 year. And you started to see this big movement down. And a lot of this is due to just cost, availability of funds, because as anybody watching this knows, children are expensive. They are a massive cost center. So as opportunity starts to dwindle down, costs start to rise, we get more and more pressure across the board. So now one of the things that we also want to look at when we're talking about the different backdrops of what's happening in China, it's important to appreciate the issues that are there on a diplomatic side. So when you look at the low light reel of what has happened, so in February, China had to deal with how were they going to manage their Russian relationship. Then in June, the G7 and NATO accused China of challenging the bloc's interests and values. In August, you had the UN High Commissioner for Human Rights release a report on what's happened in Xinjiang. In October, U.S. put China's additional export bans on the semiconductor industry. October, footage of diplomatic staff at China's consulate in Manchester physically attacking protesters in the UK. Also in December, China and India had the renewed clash in the Himalayan border. And at various points during the year, U.S. President Biden has said that he was going to defend Taiwan, which again, we already knew a lot of this, but you're seeing a lot of these pressure points. So when you look at where things are, according to the Pew Research conducted in spring of 2022, perception in many developed countries reached multi-decade lows against China. Now, if you remember, they had a wolf warrior diplomacy policy where they were going to come out tough, strong. They were going to manage this. But they're starting to soften that up a bit. And the reason why, again, the mounting anger of the wolf warrior diplomacy and Beijing's bullying tactics have taken their toll on China's relationships. But, they started to try to turn a corner a bit. And when you look at what they've done throughout the past year, the United States has been this boogeyman that they've tried to build up, but now they need a lot of support to get things back in line. And I think you're going to start to see some of this pivot in general. They've gotten closer to the Middle East, Central Asia. They've gone through different pieces, but all in all, they've confronted with drastic changes in international landscape. But you have that mounting anger, they're starting off the year a bit softer. And I think that's going to continue as they try to manage their own geopolitical issues as well as their own economic slowdown. Now, that is just layered on top of the issues that are happening on the home front, because a way to adjust the birth rate is to increase immigration. We know that they're not big into immigration. So is there a way to bring more people home, try to adjust that, try to promote more family values, or at least the cost of the family? And these are going to be important pieces to try to correct now, because they have long-lasting issues. As you have an aging populace, it gets expensive. These people are no longer working. They're taking government subsidies that they've paid into, don't get me wrong, but typically you need a certain amount of people paying in to manage, the rising inflation, the rising cost of things. So there is a lot to look at when we're kind of weighing how are they managing all of these different levels, and where do they want to position themselves in the global underlying world and just investments. So then when you start looking at China's credit impulses, you've seen that the credit impulses have not done much over the last 12 months. As we've been saying, it was going to be very lackluster. The 6-month impulse, has continued to fall by the wayside. And our view was that lower highs, lower lows, because they were going to try to manage this at a fairly flat rate. And by them, I'm talking about the PBOC, because the CCP is trying to push, borrow as much as you can, stimulate the economy. And the PBOC is like, well, we can, but to a point. Like we really have to be cautious about how much liquidity is already in the system and how much are we just adding more froth. So businesses have also been freaking out since so if you remember, Xi put into place the Common Prosperity. It was first introduced in August of 21. We've been talking about it from before when it was hinted at all the way up to now. But the Common Prosperity is it going to mean this massive state-led redistribution? What is that going to do in terms of the intervention of businesses and the economy? So when you start looking at what Lewis said, because they're at Davos now, so Common Prosperity is by no means a synonym for egalitarianism or welfarism. As China grows, all Chinese people will be better off, but that doesn't mean their incomes and level of prosperity have to be the same. That is to say, there will be equal opportunities, but no guarantee of equal outcomes. So those are comments from Liu, but remember, Liu's leaving. Like, he's out, we're going to get somebody new. Will his replacement have the same viewpoint? And that's this uncertainty. So liberals like Liu want to use CP to carry out market-oriented reforms, not so much a redistribution. But what does that mean going forward? And that's where we get a lot of this concern. And we're going to talk more about Common Prosperity, because am I going to borrow knowing that some of this money is going to get redistributed? Like, how am I going to manage my revenue if I'm going to have these unforeseen costs, which could take away my ability to pay off debt that I've already layered on? I'm already levered. The government wants me to take more, but what is my underlying additional cost going to be, or penalty, for Common Prosperity? So then we turn around and we look at Chinese foreign exchange reserves. They increased less than expectations. A lot of that is being driven by the slowdown in exports. But when you start looking at the golden share, and so state investors have taken a golden share in 2 Alibaba subsidiaries, raising concerns that the government wants to meddle even more in the tech giant's business. Now, there's a concern about Common Prosperity. There's a concern about economic growth. Exports were sluggish. We didn't get the foreign exchange, which means there was a shortage. Not as much US dollars were coming in. All the while, under a golden share arrangement, a state-owned entity takes a 1% stake in a media company in return for a seat on the board and veto power over certain decisions. So now, and this is Alibaba, obviously a Chinese company, well, what happens with what comes back to what's happening in the world today? So are you going to get pressure because now private companies are sitting there and saying, well, if this is a state-owned entity, what are you going to do to a private entity? And the structure is nothing new. They've done it before. They've done it with BitDance, Weibo. But this is not going to give people comfort, given the fact that you have a populace that was always promised to be this massive buyer. They're not. They're, Asian mindsets are more saving oriented. These people are, within China are no different in terms of their consumers. So there's a lot of fear here. Now, like, what is actually happening? What is my risk? And why am I going to invest more money into China where they've never come up to where we thought they were going to be, and now we're getting more meddling from the local CCP alliance. So then you look at monthly new loans. You had a nice increase in December, but on the aggregate side, you get an idea of how low everything was going into the end of the year. And the big reason is, well, why am I going to get new loans? Why am I going to go out there and borrow, and that is continuing to be the case. It's not that there isn't availability of debt, it's that nobody wants it. And that's what we keep coming back to, where everyone talks about stimulus and this. It's like, but who? Who is taking the stimulus? Where is it going? So then when you look at the parties delivering more officials to your door. So now you had what happened with Alibaba, but on Tuesday, Shonix Daily reported that the provincial organization department recently sent two CCP individuals to 25 large private companies in the province to run party affairs as first secretaries of their party branch. These outstanding young cadres are from province-level departments, including a section chief of the Shanix Stats Bureau. So their task is twofold: promote party building inside the companies, help the firms grow by resolving policy challenges. Beijing has long sought to expand the party's presence within private businesses, but sending in full-time officials to run party affairs marks an escalation. Previous efforts focused on requiring private firms to set up party groups and assigning part-time instructors on party buildings. Some private companies may manage to flip their party cadres into helpful government relation assets, although a few firms may be able to leverage their initiatives to their benefits. More broadly, this will further dampen business confidence and cast doubts on Xi's expression of support for the private sector. So remember what we talked about is when a communist entity goes into a struggle, they either get more communist or less. And Deng faced that, and instead they said, let some get rich. They opened up the country. They broadened their horizons. Xi is going the opposite way. And this is the concern that you have where, well, if private entities, which are already private and non-public entities, were already not borrowing, now you're putting people into their doorstep. So could this make it easier to get borrowing? Maybe. I'm not saying that isn't a possibility. But this has to be a big red flag, and it's not just this one. It's the add-ons. This is just another string of additional control, additional concern. So this is going to be, typically the private entity has to pay for these individuals. Well, that's, again, a bigger cost, a bigger uncertainty. So why am I going to lever? Why am I going to expand in this country if there's going to be more of this CCP oversight and infringement into the private enterprise? Then when you look at money supply, the survey was for 4.6%, actuals for 3.7%. Money supply, again, continuing to fall down, which is the biggest goal of trying to pull some of this excess liquidity out of the market. China GDP was expected to be down 1.1%, came in flat. China GDP year over year was expected to be up 1.6%, came in up 2.9%. I guess you can believe who you want to believe. I would argue that there is probably some massaging happening in this backdrop, but typically, things were probably better than they expected because everything was in lockdown, but when they got out of lockdown, which was really the second half of December, if you wanted to say maybe the second week of December, that's not a lot of time to make up for the issues that have been really striking the whole time through Q4. I struggle by saying that China was able to achieve this kind of growth. Especially if you followed us the whole time, we've really highlighted how poor some of the things were going on the fixed income side, the retail sales side. So that's why this tends to be a bit difficult to digest. China industrial production was expected to be up 0.1%. It came up 1.3%. But you can see that it's still a decline. So yes, it was better than the survey, but it's still moving in the wrong direction. So that you could say, well, they were able to reopen. And this is what we talked about in December. Depending on how quickly they got back to activity would indicate how quickly the industrial production ramp up and some of these other ramp ups would be. It was better than expected, but still moving in the wrong direction in terms of the level of activity. And you can see that even after reopenings, the spike has never really gotten back to where they were in 2018. 2019 was a bigger slowdown. Then obviously you had the issues and COVID of 2020. But even the reopenings never got back to it. And now that you have a slowdown in exports, a slowdown in global markets, we don't see a meaningful increase in activity when you look at what's happening in China. Now, China retail sales were expected to be down 9%. They were down 1.8% instead. Again, there was some recovery just because people were able to move about. This, I still think, is probably a bit more aggressive to the upside, if you will. But you can see that there's still, even when you had that reopening, they never got back to the pre-COVID levels. And we still think that they're going to stay well below the trend line. They may get back to some growth, but you're not going to see this big opportunity when you look at what are some of the things happening within China. Now, when we look at exports, imports, looking at it on a U.S. basis, you can see that exports were down 9.9%, better than the expectations of 11.1%. Imports were down 7.5%. Imports were expected to be down 10%. So slightly better, but again, that's just because of when things started to open. But exports on a CNY level were down 0.5%. Imports were up 2.2%. So the imports up 2.2%. Is a positive. That's something where you're seeing a bit more of a normalcy that should support exports a touch. But you can see that they fell at a steeper pace in December. And a lot of that was on waning demand. And I can't stress enough the issue that China's that is going to have on their ramp up. It's the global slowdown. I mean, who is buying what and at what rate, at what pace, which is the bigger problem. So now when we look at China's headline in general, you can see that exports came in stronger than expected, but the print is still bad news for the economy. December shipments would have been hit by COVID outbreaks that disrupted supply chains and worker availability. The more enduring trend behind weaker exports, however, is falling overseas demand as foreign households battle cost of living crisis. Back to segment 1, where we talked about this. So December's economic data has been heavily distorted by COVID outbreaks, but the weakening exports is a trend that will persist into 2023, which is something that we are going to continue to there's going to be a continuing overhang for the Chinese economy. China is the largest consumer of semiconductors, and here you can see just where the underlying China demand is, and semiconductor manufacturing sales in China as a percent of global. You can see that this slowdown is, again, a lot of these are intermediary goods. What are they bringing in? And this is a bigger problem when you look at that activity and where are they going to really resurrect some of this activity. And we don't see it. It's not something that is going to be this big pop. China's CPI came in right around where they expected at 1.8%, core CPI right at 0.7%. So pork prices continued to moderate, falling from 34.4% growth to 22.2%, but food prices overall increased 4.8% versus 3.7%, which is a bigger problem because, again, these are individuals that need to eat, even though they have deemed that they've defeated poverty. Still, a lot of people are very close to the poverty line, and a lot of that money goes to food. So as food prices remain elevated, that is going to impede how quickly those can continue to get out there and spend and try to create some sort of domestic resurrection of the economy, as exports are going to be an overhang and not seeing the consumer. China PPI was expected to be a negative 0.1, came at negative 0.7. Then you look at the entrepreneur business climate index, it's continued to fall. And we don't see that improving on an entrepreneur basis because you look at it, you're like, well, I'm concerned about common prosperity. And now some of the bigger guys, you're putting some of your CCP individuals on my doorstep and making me have them as full-time employees. That is a big concern when you look at people trying to start businesses. Activity in China, will pick up this year just because of its reopening. The problem is the support measures for the property market are going to fall flat. It's still too early to say that December is going to see some carry through because you got a lot of reaction, a lot of activity. Lunar New Year starts today, so you have the holiday that's going to kick off. And then the question is, how is that holiday going to translate into economic data. China retail sales, this puts it into perspective as to where things are right now versus historics. When you look at China retail sales and consumer sentiment, obviously there should be some bounce in the sentiment, which makes sense given people were locked away. But we don't see this big resurrection in terms of retail sales getting back to where we were. So there are two pieces of good news on the consumer front. The 20% below trend gives an idea of how much pent-up demand could be there, and consumer confidence has rebounded nicely. But based on how levered the Chinese consumer is to the real estate sector, without a meaningful adjustment to the real estate sector, we don't see a meaningful increase in retail sales. So fixed assets investment components show solid growth in infrastructure spending on the one hand, and first sign of a bottoming out of real estate investment. But as we've been saying, we just see a bottoming out in real estate investment. We don't see a recovery. And that's, I think, the biggest difference between the two that I wanted to highlight. It's just, what is that real estate investment going to look like? It's still negative. It's going to stay negative. And if anything, we actually think there's another down leg on the real estate side, because we're just starting to get through this. And infrastructure spending, even though it's been pushed time and time again, every time exports fall, infrastructure spending gets pushed. It doesn't mean that we're going to see this meaningful pop up, because a lot of this stuff is going into projects that just don't make money. So then when we look at China floor space started, you can see that it's the lowest level since March 2009. China floor space sold, again, moving back down. So even though you're seeing some of this bottoming in real estate, this still needs to be seen in floor space started, which remained at a 13-year low, and residential demand, which went back to a new cycle low, which again is showing things on the ground and the problems that we've been talking about. China retail sales value, giving you an idea of kind of where things are versus the value side. But again, as China new home prices month on month came down again, they fell minus negative 0.2%. That's again a continuation as people who are so levered to the real estate market, as these prices dwindle, as they get write-downs, as their value falls, that is hitting people, their portfolios directly, and is going to keep some of the cash, because this is what keeps coming back, is the household consumption has been persistently below trend. So you've seen it where quarterly household consumption, monthly retail sales, and you look at the 2017-2019 trend line, even on the reopenings, you're just not getting back to that. But household debt to income ratios have flattened since 2021 because people are saving more. But are they saving because their portfolios have gotten so destroyed because of their leverage to real estate, and that they're looking at this and again, coming back to the fall in population? There's already ghost cities. You already have this breakdown. And now there's a steep drop, because we talked about it in segment one. There is going to be a steep drop in the population within China, which is going to create a reverberating impact in terms of the amount of buyers, the amount of workers available. So, and as now you see, a lot of these people might have had their life savings or their savings or their retirement wiped out. What is that going to do to their ability to consume? So the China residential property sales closed out the year at a low. And then when you look at China's PPI over a period of time, you can see that things are still kind of bouncing around, not so much deflation, but just staying in this steady point, which is what China kind of wants at this point, because they want to try to keep CPI low. They want to try to keep inflation down so that consumers have a reason to buy. There's the availability to go out there and spend. But then when we start looking at Chinese exports, well, you still have to offset that. So they're trying to do it through infrastructure, but infrastructure's still been sluggish, not enough to offset exports. Can the Chinese consumer offset the drop in the export market? And so far, the answer is no. Now, the property market excess is exactly what we've been talking about, because 18% of GDP for 14 years has been the property. Land price proxy, 80-fold in 19 years. So when you're thinking about the sheer size of what this has meant, so not only do you have exports that have slowed, you have infrastructure spending that has tried to come up, you have the consumer sitting on the sideline, now you have to make up for the property market excess. And given how it fell again in Q4, could they really have managed a Q4 that is 0% GDP growth? So this is another piece that keeps getting pulled back. Chinese households added 15 trillion yuan in new deposits in 22. A small amount of this wealth can generate a consumption boom, as happened in 2021. But even that quote unquote boom in 2021 was still well off of pace previously, and still well below pre-COVID levels. Chinese household deposits year-on-year trend, to give you an idea, but how much of that is offsetting the losses because remember, it's an Asian nation. Asian nations, their consumers are typically net savers. How much of their savings has to be restocked because of all of the losses they took on their portfolios or their real estate holdings? Because even some of the lower middle class individuals who wanted to try to rise up, wanted to take advantage of some of these investments, levered themselves to do so. So I struggle to see, and again, there's no clear data that says, well, this amount is here, this amount is here. I think that there has to be a weighted average in terms of how much of this is actually available to get pushed into the market. Aggregate government spending continues to fall. They're trying to, they're talking about increasing their deficit a bit. Local government spending also falling, central government spending coming down. So they're trying to reverse that a bit and provide some additional capacity. But how much spending can really be managed? How much spending can really come through this market, given they've been spending nonstop since 2014? This is a big issue in terms of where the value is and how are they financing it. And that's the biggest problem, because a lot of the finances came from the real estate market, came from real estate, and now that's going away, or at least not coming back to the same degree. They've been relying on the PBOC. They've been relying on a lot of these different pieces, which has become very overwhelming. And again, they just don't have that backdrop and that essentially the money in the kitty to continue to do so. Now turning to Japan for a minute, the 10-year government bond yield broke the ceiling, as you can see that they've been trying. And it's just, when you look at where they are, the Japanese, the BOJ can't continue this. They have no choice but to pull back. And the reason why is because inflation is ramping up. You have Japanese machine tool orders. You can see that they came in okay, but not where they'd like them to be. So the economy is, again, coming into this stagflationary backdrop, and they've been running this BOJ spending game for a very long time, creating a lot of these issues. So Japan government bond curve, you can see that they've been trying to hold this level, but as it keeps breaking above the 50 basis point line and they're buying bonds, they're pushing more yen back into the market. As we've been saying from the beginning, they're gonna have to yield. They can't manage this. It's just overwhelming, and it's something where they're gonna have to let the free market take hold, which is gonna put more pressure on the bonds and just what their yields are, but it should help alleviate some of those inflationary backdrops. So when you look at economy watchers, a survey was for 45, came in at 47, slightly better. Bank of Korea raised rates again. And again, they're raising rates is the name of the game at this point, to try to get in front of inflation, which is why when we look at the BOJ, they're going to have to follow something similar to what Bank of Korea has done and get away from this trying to put in a ceiling. Real wage growth is deeply negative in Japan, and this is the underlying problem, because what we've seen with QE and what we've seen with MMT is the degradation of real wages, because wages have not kept up with this very steady level of inflation. And we've seen that QE and MMT creates a stagnant economic growth where there is none, while wages continue to deteriorate. And that is a problem that is now being compounded going into an economic slowdown with Japan machine orders year on year. Survey was for 1.6, actual came in at negative 3.7. So it's another level of pressure, another level of that drop, which again creates more pressure. So then when we look at the scheduled purchases versus the actual purchases, and you can see that the actual purchases have far exceeded schedule because they've had to step in multiple times to maintain their target. Now, when you look at underlying and fresh inflation percentages, you see this massive shift higher. And you might think, but the pieces are better. And in terms of energy cost, and this is when it gets into what is the definition of inflation. And the problem is there's more and more monetary stimulus coming through. And as central banks dump money in, that inherently increases the inflation, even with some of the internal prices going down. And that's when we start getting more into the economic esoteric means of inflation. So as the BOG tries to maintain actual purchases to maintain the 50 basis points, they're actually driving up underlying inflation, creating more problems, which is why we do believe the BOJ is in a debt problem and in a debt spiral that is going to cascade into other markets. India exports were better than expected, slightly below where they were in 2021, but you can still see very strong. Trade balance came in a bit worse than expected, which again is something to watch because we do see more pressure in India coming up. India index of industrial production came in better in November, but as we said, we expected a bounce better in November, but then something a bit worse in December. India index of manufacturing production, again, something very similar in terms of where we see on the manufacturing side. On the industrial side, we just see exports slowing and putting some pressure on that. Now, when you look at inflation came down to 5.7% in December, but the problem is core inflation actually was only at 6.4%. So the core side, it remains the problem. And we've said this, and you're seeing a pattern in terms of core being the overarching problem that is hitting different countries. The components of core inflation point to a mixed picture. The uptick was mainly due to higher prices in gold and silver, medical care, education, and some stationary categories. Most other components, housing, clothing, transport, communication, saw some drop. But looking ahead, there should be some core inflation that continue to come down in general. But again, the jump in freight costs in December posed some upside risk. And now you have some different pieces in general. Daily food price data suggests inflation could come down a bit lower. But that's also going to be supported by what is being done by Modi, which is increasing the amount of subsidies into the market. So food category is a leading indicator on the inflation side. So when you look at where the inflation is going, food is becoming a bit of a deflationary factor, and that's really driven by the free grains could shave about 30 to 35 basis points from the headline inflation. Modi administration distribution of free rice and wheat to the poor will lower inflation. And that's because, as we've said before, food is such a huge component of the emerging market, and that is a big problem when you look at other emerging markets because they're now running a steeper deficit. And as the Indian economy slows, that deficit's going to be harder and harder to maintain. And that's where we see some of these pressure points. So they're trying everything to maintain it, and they're doing a good job so far. But we do believe that India is that last shoe to really drop. Then when we look at India wholesale price index, it was expected at 5.47, came in at 4.95. Core inflation is persistently higher, and that's where they're trying to get it below 6, but it's still sticky there. The food subsidies will help, but that's more of a one-off. And then as you're not exporting rice and wheat into the market because you're keeping it onshore, trying to bring down those costs, you then increase costs elsewhere, which again then creates more inflation abroad, increases inflation that's imported, all the while your deficit is increasing. your budget is getting worse, and then your cost of capital is going up because rates are going up in general. So it's a short-term benefit, but it's going to create a long-term problem. And again, that's something to be watched as we progress through this year. Now, when we start looking at some of the different pieces, stock prices will fall as firms face rising borrowing costs in both nominal and real terms. And I think that's the biggest issue when you start looking at activity in India, is that lending rates are going up. So even though the government is doing more, local companies are doing less. And I think that's a bigger problem over time when we start looking at those lending rates and that pressure point, which is going to cut CapEx, cut industrial production, excuse me, which is why we're more bearish India in 2023. And we think that's going to be a problem as we progress through the year. So if you have any questions, again, feel free to reach out to us through the comment section on Twitter. And we always appreciate hearing from you. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.